Welcome back to our special discussion on the first quarter GDP numbers that have been announced. The GDP growth has come in at 8.2%. Our expert panel comprises Dr. Pranab Sen, Sajid Chinoy and Soumyakanti Ghosh. Well, before going into the break, we were discussing about whether the potential growth itself has increased, and our experts think no, it remains around 7.1, 7.2, which it was in the early 2000s. We've not improved that. But there is an 8.2% growth, and there is a possible current account deficit of 3% if we continue with the current trade deficit. So, implications for policy. Soumya, would you say the time has come to cool down aggregate demand a little more? A third back-to-back rate hike, you think is warranted?
In terms of the growth rate, I will say that I'll just take a different perspective in the sense that if you look into the RBI statements and RBI intervention patterns in the foreign exchange market in the last couple of days, I think there is a visible thinking possible in the central bank circles that more amount of forex intervention actually leads to, and that is which is the sterilization, leads to increased cost. And over a point of time, that may not be beneficial for the economy, but leads to a higher term structure of interest rates. So if that is the possible thinking, and given the fact that RBI possibly has not been intervening aggressively in the rupee market in the last couple of days, but the rupee is now close to 71, possibly it could breach that, possibly it could rebound. I think not because of cooling down aggregate demand, because we had two successive rate hikes, and that will that monetary policy rate hike will play out over a point of time, and also the fact that the inflation number this month could go well below 4% because food prices continue to remain significantly depressed. But my sense is that if the central bank is not in favor of too much of depletion of foreign exchange reserves, it could look at other options to defend the currency if it continues to depreciate. And against that background, I think one of the possible options, textbook prescription, is foreign policy is a rate hike. So that is the thing. So that we need to see whether that is the thinking, or it wants to see some of the numbers play out before trying to stem a fall in the value of the rupee if it continues to do so.
Okay, your thoughts, Sajid? Isn't it time to cool aggregate demand a little more? An October rate hike?
Well, I think the October meeting will be a dilemma. I think the MPC moved in June and August precisely because it thought those back-to-back rate hikes would buy it some time. We all anticipated that inflation, because of base effects, would optically come down. The inflation numbers, in fact, will surprise to the downside, I think. In September, you could get a sub 4% number. But that's all water under the bridge. I think, if we're seeing emerging markets with current account deficits come under sustained pressure over the last couple of weeks, if that pressure continues on emerging markets and on India for the rest of the month, it will be very hard for the RBI not to do something in October, no matter what the inflation prints say, because we can't be losing reserves at this pace. There is no reason to panic again. I think I keep saying we have enough, but what we're realizing in this world is orthodox signaling from emerging central banks matters a lot. Indonesia had to front load, and that's helped calm some of those markets. Turkey and South Africa have not, and they've paid a heavy price. So I think the RBI will have to look forward and say, you've had a depreciation which is healthy, that is going to have some inflationary consequences going forward. Oil is now upwards of $75, and if the rupee is under sustained pressure, I won't rule out a rate hike in October. I think it'll come down squarely to the rupee. If the rupee settles down and this is just a 2-week story, I think the October meeting will be a pause. If all of September we have this kind of stress, I think the central bank will have little choice but to move in October. You can't wait 3 months for the next rate hike in the kind of turbulent global environment we're saying. One last thing that I'll say to link up these two factors. We've been arguing for a while that some degree of currency depreciation is good, it's healthy, and you've already begun to see that in today's numbers. We've had a 6% real depreciation in the first 6 months of the year, and already in the second quarter, the drag from net trade, exports have picked up, imports are still strong, but the drag from net trade in today's GDP number is meaningfully less. It's the lowest in the last 5 quarters. So these things do pan out eventually. The more the exchange rate works, the less we have to curb aggregate demand to contain the current account deficit.
Okay. Dr. Sen, time to cool aggregate demand? Another rate hike?
There's another factor, I think, which we haven't taken into account, and this is going to come into play in the last 2 quarters, is the election effect.
Okay.
Traditionally, every time elections have happened, the demand side has boosted by anywhere around 0.4 to 0.5% of GDP. And I see no reason to believe why it's going to be different this time around. It isn't going to be different. So if the RBI does factor it into account, they are potentially looking at a massive increase on the aggregate demand front, and they may have to take measures at that point, which would make for very, very interesting economics in the country.
Oh, okay. So what you're saying is, for the rest of the fiscal, not just one more, but possibly 2 more hikes?
Well, that depends. I mean, frankly, the election impact usually starts 4 to 5 months before.
Okay.
So it could begin in the 3rd quarter, or it may begin at the end of the 3rd quarter and mostly in the 4th quarter.
Okay.
So that's something that people have to keep a weather eye open for.
No, absolutely. And actually, the RBI has its eyes absolutely open on that. We had the Deputy Governor, Mr. Kanungo, make a speech where he spared nothing in terms of the way in which fiscal deficit targets have already been breached by the state government's deterioration in the year gone by and the targets for the current year. So almost reading the right act on the way the fisc is progressing. But Dr. Sen, what is the chance of, a far more pronounced improvement in growth? Because we often tend to, there have been times when people underestimate the bounce up. You have a rupee depreciation effect which could increase growth. As you said, an aggregate demand effect which could increase growth. The NPS cycle is definitely ending. That could have its own buoyancy impact. Do you think they are actually going to be surprised? And although there is a big base effect for the 3rd and the 4th quarter, is there a good chance that we are going to end the year as well with a 7.8% kind of growth?
Well, the big problem in all of this is agricultural distress.
Okay.
So you're talking about a very, very large percentage of the population whose real incomes are going down. So yes, you have these other effects playing out, but as Shomo rightly said, agriculture prices just continue to get weaker month on month.
Okay.
And that's worrying.
Oh.
So that's going to be a major dampening factor. But if construction keeps up, we are keeping our fingers crossed, yes, you could have an upside.
Okay, Shomo and Sajid, I want quick answers from you on that. How much would you revise up the growth forecast for the full year? Sajid?
So I think we're going to revise it up to closer to 7.3%. Lata, there are some tailwinds you mentioned, but also some headwinds. Oil at 77 this year is a negative terms of trade shock. And remember, monetary conditions are beginning to tighten or have tightened in the last few months and may tighten more of the currencies under some pressure, and the RBI has to move. And the deleveraging is progressing, and that's going to have some dividends down the road, but we're not seeing credit growth accelerate sharply. So I think if we can end the year with 7.3%, which is our current forecast, I think India will be doing very well in a turbulent global environment.
Shoumya, your final number for the full year, has it changed from what it was before you saw this first quarter GDP number?
No, we are actually at the GDP, GVA at 7.3 and GDP at 7.4. And one small observation we'd like to make,
Sure.
Lata, before the closing. I think today the credit growth number has also come.
Yes.
And if we actually look into the data, I think credit growth is up only in the personal loans and the housing segment, and it is down in all other segments. So that indicates that the demand growth which we are talking about is still not yet achieved within the economy. So that will be one factor at the back of all the policy decisions going forward also.
Yes, of course. 12.9% credit growth and only, I think, about 8.9% deposit growth. That also will be a problem. But overall, let's end it positively. It's been a good number, an 8.2% growth. And we could have positive surprises, going forward as well. As Dr. Pranab Sen points out, aggregate demand normally increases in an election year. We could have some benefits because of rupee depreciation increasing domestic activity and export activity. So we could see higher growth, but that will also invite more action from the Reserve Bank in the form of interest rate hikes. The hikes already done will also play out. We live in interesting times. That's the best we can say. Thank you very much, Dr. Sen, Sajid and Soumya for joining.